Yesterday may have been the largest day for the US stock market for the rest of 2025. Since then, the stocks have started falling, with Meta falling by 10% in just one day. So what is going on? Well, in this video, I'm going to explain 4 key things. Number 1, the Fed's interest rate decision. Number 2, Google's earnings. Number 3, Microsoft's earnings. And finally, number 4, Meta's earnings, which all happened in just one day. So let's get into it. Hi, I'm Milan. I'm an economist and I help to break down financial news and help you become a better investor. Right, so the first things first, let's take a look at the Federal Reserve's interest rate decision. And we can see that they decided to lower their interest rate by 0.25%. Now, this is important because what it shows is that they believe the US economy needs help. GDP rose at 1.6% for the first half of the year, but what they're not telling you is that most of that growth came from the build out of AI data centers. Without it, growth would have been less than half of that. Now, they reckon that the growth came from stronger consumer spending, which may be true, but what it doesn't show is that consumers might be taking on more debt in order to fund their expenditures. Now, due to the government shutdown, some economic data is being delayed. However, from what they have, they've said the available evidence suggests that both layoffs and hiring remain low. And this is important because although layoffs from their point of view might be low, hiring is low. And with the new influx of graduates, that's going to mean unemployment gets worse, especially among the younger generation. Now, they've also said that near-term measures of inflation expectations have moved up, on balance, over the course of this year due to tariffs. Higher tariffs are pushing up prices in some categories of goods, resulting in higher overall inflation. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level, but it's also possible that the inflationary effects could instead be more persistent, and that is a risk to be managed and assessed. Now, here's where I stand on this. If you're a business owner that's been hit with tariffs, let's say you're producing bed sheets, and you have to compete with 5 other businesses. Do you really think that you're going to pass on the cost of those tariffs onto consumers in one go? In fact, you might not pass on any cost at all for as long as you can. And here's why. If I were a business owner, or you were a business owner, and you passed the cost of the tariffs to consumers, what do you think would happen? They would go to your competitors. And that is what business owners know, especially businesses who aren't monopolies. And so what happens is that businesses will not pass on the cost of tariffs for as long as they can. So they will take the hit for as long as possible, or what they might do is increase prices slightly, but not overdo it because they don't want to push their customers away to their competitors. So every business is doing this, which means higher tariffs won't lead and have not led to a one-off price increase. Instead, it will be very slow price increases over a much longer period of time because companies want to do this ever so slightly in the hope that you won't notice their price increases and they don't have to compete on price against their competitors. So that is what I think is going on, which is why I do believe that inflation will remain elevated for some time yet. So that is where my views differ against the Federal Reserve's. And to be fair, we have also been seeing that in the data with inflation remaining elevated at around 3%. Okay, so what they're saying is that they can see risks to employment, that job hiring is very low, and there aren't many job opportunities either. At the same time, there is a risk that inflation could go up, which is the worst case scenario, right? It is basically stagflation. Low or no economic growth. We know that without the AI data center rollout, growth in the first half was around 0.6 or 0.7%, and inflation is still above 2% target. In fact, it might rise above 3%, primarily due to the tariffs. So when you're in a position like that, it makes it difficult to make a policy adjustment because you could reduce interest rates, but then that could cause an increase in inflation. And so what they've done as of yesterday's announcement is to drop interest rates slightly by 0.25%. But what they also said was that in December, if I can find it, it is not guaranteed that they're going to lower interest rates again. What they said was that that is going to be an ongoing thing based on the data that they receive. And so that has also negatively impacted markets because markets have been increasing in hopes that the US Federal Reserve will increase interest rates again in December. But what they have said is that they haven't made a decision. Here it is, I've just found it, and it's here. A further reduction in the policy rate at the December meeting is not a foregone conclusion. It's far from it. And I believe this is the line, the sentence, that have spooked investors. What is also important to note before I leave this is that they said the committee also decided to conclude the reduction of our aggregate securities holdings as of December the 1st. Now, what does this mean in layman terms? Well, what it means is, from December the 1st, they're going to start pouring money into the US economy once more, thereby reducing the value of the dollar and potentially increasing inflation. This is important to know because generally when the value of the dollar declines because the supply of dollars in the market goes up, asset prices also go up. And so that is extremely important to know. So from December onwards, the value of your money is going to be going down. And many investors will seek to own assets like gold and silver, as well as in equities, in order to protect the value of their money. Alright, so that all being said, let's now move on to earnings. And let's start off with Alphabet, the owner of Google. Looking at Alphabet's earnings, I want to draw your attention to this. YouTube ads went up from around $9 billion to $10.3 billion for the quarter ended September 30th in 2025. That's a good increase and it shows that YouTube continues to grow. However, look at Google Network. I'll zoom in here in case you can't see it. Google Network's revenues fell from 7.5 to 7.35 billion for the same quarter the following year. That is important because what it is showing is that Google is losing ad revenue from people searching on Google and then getting sponsored posts and results. So this is actually where now these large language models are causing Google to lose out. That is important for what's coming up. Now, their cloud revenue increased from $11.35 billion to $15.6 billion. That is a huge year-on-year increase. And it's something, and that is probably what's caused Google's stock price to actually increase. And they are the only companies whose stock has increased since yesterday, at least among the Magnificent Seven and the major hyperscalers. But I want to draw your attention to this. With the growth across our business and demand from cloud customers, we now expect 2025 CapEx to be in the range of $91 to $93 billion. And there will be even more spend in 2026. Now let's just think about that for a second. Google's revenue from cloud for the year is going to be around $70 billion, maybe less. Their spend on cloud infrastructure is going to be around $93 billion. That is $23 billion more spend than they're earning. And they reckon that that's going to increase in 2026. So we can assume over $100 billion are going to be spent on AI data centers in 2026. That is surely going to be more than they bring in from Google Cloud. So right now, they're losing money on it. And here's the problem. Over the long run, the chips, NVIDIA's chips, even Google's own chips, will need to be replaced every 3 to 5 years with newer hardware. So the more data centers they build, the more the long-term costs are going to be. And that is a real concern. However, because of Google's strong growth in Google Cloud, that has sent their share price actually up by a few percent since yesterday. Moving on to Microsoft, and it's a similar story, but there are a few differences. So what we can see is that their revenue was up by 18% to $77.7 billion. And what Satya Nadella said was that our planet-scale cloud and AI factory, together with co-pilots across high-value domains, is driving broad diffusion and real-world impact. Now, you've got to take this up. You can't take this at face value. What he also said was, it's why we continue to increase our investments in AI across both capital and talent to meet the massive opportunity ahead. Now, let's look at Microsoft Cloud. Their revenue was $49.1 billion for the quarter. You know, what they've said, okay, yeah, it's a 25% increase in constant currency, which is, again, very good growth. However, when you look at how much they're spending, alarm bells start to ring. Now, from cloud, yes, they generated just under $50 billion. And looking at their presentation, we can see that the cost of revenue was $24 billion. $24 billion is the cost of revenue and $15.7 billion operating expense. Now, we can expect both of these to go up over the course of 2026. In fact, looking at the 2026, the next quarter, Q2 outlook, they're expecting the cost of revenue to be around $26.5 billion and operating expenses of around $17.3 billion, which, if you look back over here, is around 10% higher than it is currently. So in one quarter, they're expecting their cost to go up by 10%. Now, it's great when they've got such high cloud growth, but they're still spending more because their intelligent cloud brought in $30.1 billion, but their cost of revenue is $24 billion. That alone covers most of the revenues they've earned from their intelligent cloud. And so that also starts to raise alarm bells, but it gets slightly worse than that. And here's why. If you look at their other income and expense, they made a loss down here of $3.7 billion, which they've hidden away. Now, what is that? Well, that's down to their investment in OpenAI. And I just want to show you something. So Microsoft have now made a significant investment into OpenAI, and they hold an investment in OpenAI Group, BBC, valued at $135 billion, representing roughly 27%, in fact, of the company. Excluding the impact of OpenAI's recent funding rounds, Microsoft held a 32.5% stake on an as-converted basis in the OpenAI for-profit. Now, OpenAI used to be completely non-profit, but they're slowly shifting to become a for-profit organization, and that was one of the reasons for a massive ruckus earlier in the year among their executives. So with that being said, this sounds like a good thing, right? That they're expecting OpenAI to at some point declare AGI, Artificial General Intelligence. So they're making it sound like this amazing thing. But what no one is saying, and it's the reason for Microsoft's loss, is how much OpenAI is losing. Now, according to this article from less wrong. In fact, they're referenced a New York Times article. OpenAI is on course to burn over $26 billion in 2025 for a loss of $14.4 billion. And it's very likely that will get worse next year in 2026. So OpenAI is not profitable. They are burning through money. And that explains why they are planning for a potential IPO later in 2026. Because although they're projecting $20 billion of annualized revenue by the end of 2025, they're losing money. They're burning through money. They're losing more money than they're making, and they cannot sustain it. And as a result, they're going to go through an IPO, become a public company, and use money from shareholders to fund their losses. Once again, that's important to know, because this is where investors start talking about an AI bubble, where there is so much investment going on into something that might not generate a positive return on that investment. Now, finally, let's look at Meta. The family daily active people was up an increase of 8% year over year. Ad impressions increased 14% year over year, and average price per ad increased by 10% year over year, leading to a revenue increase of 26% year over year, or on a constant currency basis, 25% year over year. But here's the reason why Meta's shares have declined so much in one day. So they expect their full year revenue to be, if I show you this, so over here, they're expecting around $200 billion of total revenue for 2025. But the scary thing is, they expect their full year 2025 expenses to be around $18 billion, which is more than half of their revenues. And this is all due to investments in artificial intelligence. Now, that is scary because they've also said that they're expecting their 2026 capex to be notably larger next year than in 2025. We also anticipate total expenses will grow at a significantly faster percentage rate in 2026 than 2025, with growth driven by primarily infrastructure costs, including incremental cloud expenses and depreciation. So that is extremely important to know, that while their revenues are increasing, they're taking pretty much all of their profits and flinging it at AI. And investors are scared about this because any return on investment isn't guaranteed. Now, with multiple companies popping up and all battling to have AI and AGI, whether or not that is even something that technology at the moment can even do, what it could lead to is a race to the bottom, where most people are only using something if it's free or low cost. And that is another thing to worry about. But for Meta in particular, they're throwing so much money at AI, which people aren't using that much right now, that investors are getting worried. But it also means that their earnings per share estimates for next year are probably far too high. Like for this year, they were expecting earnings per share of $25 odd per share. But we already know that from their most recent earnings, that's going to be a miss. I mean, just look at how much they missed. This massive difference from $6.72 per share to $1.05 is all due to investing in AI infrastructure. And that is going to continue into 2026. So of course, that means that Meta's earnings per share next year might not be around $30. It might even be less than $10 per share. And of course, that is going to have a massive increase, or rather a massive change in the outlook for their share price. which is why we see Meta's stock right now it's down over 10%. And I do believe it has a lot further to go because of this announcement. Because as I mentioned, there is no guarantee that the investment in AI infrastructure is going to yield any positive results. And that is what is scary to investors. If you found any value from the video, please leave a thumbs up, subscribe, and I will see you on the next one.